Welcome students to Module 5. From Module 3, we know that the time value of money comprises three components. Number 1, compensation for foregone consumption. Number 2, an allowance for expected inflation. And number 3, risk. In Module 4, we saw how we can value bonds and shares using discounting models. Valuation looked easy because we knew what the future cash flows would be, and we simply discounted those cash flows at some discount rate. But how did we come up with that discount rate of return? Who decided that, for example, assets with similar risk require return of, say, 20%? How did we estimate that 20% to use in our share valuation, for example? In this module, we start looking at just that, returns and risk. First, we introduce the basic return calculation and risk. Then we discuss expected returns for a single asset. We then introduce the concept of a portfolio and the principle of diversification, which will lead to a more detailed discussion on risk. From that, we go on and learn how to calculate the required rate of return using the capital asset pricing model, the CAPM. And we finish the module with the discussion about security market line, or the SML, and efficient markets. I go regularly to gym, every day actually. And last year I had a personal trainer to motivate me more, and he kept saying to me, no pain, no gain. If you want to see result, you have to put more effort, work harder, suffer pain. We can apply this saying to finance as well. If you want higher return or gain, you must bear more risk or pain. We observed that by investing in Australian shares, we would get a higher return than investing in international shares. But also we would have to take on more risk. The interesting thing in the table is that by combining Australian and international shares in a portfolio, we can get almost the same returns as Aussie shares, but with considerably lower risk. That is the power of diversification, and we will talk about that in this module. This graph shows an overview of the Australian share market from 1900, displaying major events along the years. We observe that despite major events like the Great Depression, World War II, the terrorist attack, and Asian tsunami, the stock market has an upward trend. The lesson to learn is that at times markets go down. However, markets always recover and over the long term will go up. Therefore, put some money in now and forget about it. Maybe look at it when you're ready to retire. If you have an investment, an asset, whether it's a house or a share, you can always calculate the return on that particular asset, whether you sell it or not. Based on the initial money invested and any cash that we receive from it in the form of dividends or rent, and the market value of that asset at a particular point in time, we can calculate a dollar return or a percentage return. So the components of returns are the income received and the capital gain or loss due to changes in the asset value. So to calculate a dollar return, we add the income received plus the change in the value of the asset, whether it's a capital gain or loss. And to calculate a percentage return, we add the income received plus the change in value of the asset, and then divide that figure by the original investment amount. Or divide the dollar return by the original investment amount. What happens if we don't have any income? Well, the dollar return is just the change in value of the asset, the capital gain or the capital loss. And the percentage return becomes the change in value divided by the original investment. Let's look at this example. Terrell bought 100 shares of MicroOrb shares for $25. A year later, he received $1 per share dividend and then sold the shares for $30 a share. Therefore, its dollar cost, the original cost, was $2,500. What is the dollar return? The dollar return is based on the dividend received of $1 plus the change in the value of the share multiplied by the number of shares, so $600. What is the percentage return? The dollar return, 600 divided by the original cost, comes to 24%. On the other hand, Owen bought 50 Garcia Limited shares for $15. A year later, there were no dividends, and he sold the share for $25 a share. The dollar cost was $750, while the dollar return is based on just the change in value because there were no dividends, so $500. And the percentage return is just the change in value, 500 divided by the original investment, 750. So we can also calculate the percentage return as ending value divided by the beginning value minus 1. That's an easier way, faster way, and we should get the same result. So in percentage terms, Owen's investment performed much better than Terrell's did. So in finance, we don't think about dollar return, we think about percentage return. Terrell's dollar return exceeded Owen's by $100, from 600 to opposed to 500. Can we say that Terrell was better off? No, because Terrell and Owen's initial investments were different. Terrell spent $2,500 in initial investment, while Owen spent only $750. So percentage returns allows us to compare investments. Now take time to do this quiz where we have the following information for a share. We are given 4 prices, and the problem is asking what are the yearly returns for share X and what is the average return. Note that here we are given prices. Thus, from prices we need to calculate returns. So the number of returns are always n minus 1. So if we have 4 observations, 4 prices, we end up with 3 returns. So the returns are 15%, 20%, and negative 20%. The average is calculated as just the sum of returns divided by the number of the observation. So in our case, we have 3 returns, 15%, 20%, and negative 20%, divided by 3, and we get an average of 5%. This average return is also known as an estimated return. By looking at this figure, we see that the value of $1 invested back in 1900 would have grown to $2,459 by 2011 if you have invested in shares. Would have grown about $5.70 invested in bonds, and only about $2.20 if you invested in treasury notes. So what is risk? Risk in everyday terms is viewed as a negative. Webster's dictionary, for instance, defines risk as exposing to danger or hazard. The Chinese symbol for risk gives a much better description of risk, at least as far as finance is concerned. The first symbol is roughly the symbol for danger, while the second is the symbol for opportunity, making risk a mix of danger and opportunity. You cannot have one without the other. Oxford Dictionary defines risk as the chance or possibility of loss, or the uncertainty of future outcomes. Or if we quote Donald Rumsfeld, the former US Defense Secretary, in his view, risk is the unknown, and in he regards there are 2 kinds of unknowns: known unknowns and unknown unknowns. This quote is quite funny if you look at it. Remember, we said that one of the issues in share valuation is the uncertainty of cash flow. We're not sure whether the company will pay future dividends, whether they'll have enough earnings or growth in capital. Why aren't we sure? Because these outcomes depend in part on how the company is run and in part of economic forces and the market. We don't know what the market is going to do tomorrow. And that's why we have risk. We can say that these are the known unknowns, the known risk. We know it's there. We know that we cannot predict accurately the future cash flows of a company. However, nobody knew that September 11 will bankrupt so many businesses and forever change the way airline businesses are run. Nobody knew that Russia is going to default on their foreign debt and cause havoc all over the world. Or that the Kobe earthquake will cause Nick Leeson to bankrupt Barings, the oldest investment bank in England. These are the unknown unknowns, the unknown risks, the unimaginable risks, the one that you cannot even dream about, and the ones that can hit you and leave you stunned and with permanent damage. So in finance, we don't so much as avoid risk as manage risk. Good businesses avoid some risks, others pass it through to their investors, and others actively seek it out. When businesses want opportunity, like higher returns, they have to live with higher risk. Most would know this already, but the key difference is that in finance, we quantify risks in a way that enables us to manage it better. So how are we going to measure this risk? In finance, the variance and standard deviations are the main measures of risk, where variance measures risk in units of percentage squared and is the sum of the squared deviation from the mean divided by the number of observations minus 1. The standard deviation is a standardized measure based on the assumption that returns follow a random process and have a normal distribution. To calculate standard deviation, we just take the square root of the variance. Note that these formulas apply to historical variances and standard deviation. So the greater the variance and the standard deviation, the greater the uncertainty of future outcomes will be. So the larger the variance is, the more spread about the mean are the outcomes, so the more volatile or uncertain are these future outcomes. Therefore, the variability in the returns of an investment indicates the total risk of investing in that particular asset. Let's have a look at this example. Suppose we have this share and for the last 4 years have returned the following. In year 1, they've returned 15%, year 2 to 9%, and so forth. What is the variance and standard deviation? So the first step we do, we need to calculate the average return, which is just an arithmetic mean. The sum of each year's returns divided by the number of years. And we calculate that to be 10.5%. The second step, once we know the average or the mean, we calculate the deviation from the mean, R minus R mean. Note that when added up, these deviations from the mean must equal 0. If that's not the case, you've made a mistake somewhere. The third step, we square the deviation to remove the negative signs and add the squared deviations. That's the symbol for the sum, where we add all the square deviation to get 0.0045. The fourth step, once we have the sum, we divide by n minus 1. We divide by 4 minus 1, and that is the variance, 0.0015. Calculating the standard deviation is easy. We just take the square root of the variance. Therefore, the share has a risk of 3.87%. If we draw the normal distribution, we can say that in relation to this normal distribution of returns, approximately 68% of possible outcome lie within plus or minus 1 standard deviation of the mean. So 68% of possible future returns will lie between 6.63% and 14.37%. How did we calculate these figures? Remember, it's the deviations from the mean. So we take the mean, 10.5, minus 3.87, one standard deviation, to give us 6.63%. And then we take the mean, 10.5, plus one standard deviation, plus 3.87, to give us 14.37. Or we can look at these two returns and say there is 68% probability that this share will not lose more than 6.63% or earn more than 14.37%. In Excel, we use the VAR and SD function to easily calculate the two variables as presented here in the screenshots. This table shows the historical returns for various asset classes in the Australian market from 1979 to 2011. Looking at the average annual returns and standard deviation figures, we see that the small company stocks have outperformed all the other series. However, they have had the greater risk or the greater volatility of 31.68%. Remember, the higher standard deviation of returns, the higher the range of future possible outcomes. Therefore, more risk associated with that particular investment. So asset classes with greater volatility pay higher average returns. Average return on shares is more than double than the average return on bonds, but shares have 2.5 times more volatility. As we said at the beginning, investors who want higher returns have to take more risk. The incremental reward for accepting more risk is relatively constant. So what lessons can we learn by looking at the past returns in the capital markets? The data and the figures tells us that there is a reward for bearing risk, and the larger the potential reward, the greater the risk will be. The treasury bonds and bills have little risk but very little return compared with the more riskier bonds and shares. We say that there is a trade-off between risk and return. You cannot have a higher return without bearing a greater risk. The greater the standard deviation or the volatility of returns or the risk, the greater are the rewards or the returns. Hence, there is a positive relationship between risk and returns. Now, risk premium is defined as the extra return required from an investment in a risky security over and above the return on a risk-free security. The risk premium is what investors demand for investing in an average risk investment relative to the risk-free rate. Small cap shares have a high risk premium compared to the shares of larger companies. Small companies also have higher risk than larger companies. But what is a risk-free rate? For a risk-free asset, the actual return must return the expected risk return. Therefore, there is no variance around the expected return. The risk-free rate also must have zero correlation with the market portfolio. Also, there has to be no default risk, which generally implies that the security has to be issued by a government. Note that not all governments can be viewed as default-free. Treasury notes are said to be risk-free government securities because in general they have the lowest standard deviation and should be used when performing short-term analysis. Sometimes the government might not issue treasury notes, like it was in Australia for a period of 5 years in the mid-2000s, so we didn't have a rate of return for treasury notes. That's why in that period we used the 10-year government bond yield as our risk-free rate. This is generally used for long-term analysis if we use a longer maturity government security as the risk-free rate. These securities are considered risk-free only in the sense that if they are held to maturity, we expect that the interest and repayment obligations will be fulfilled by the government. We are certain of receiving the interest payments. There is no risk that the government will default on the coupon payments and the principal. However, they are still subject to interest rate risk. In the previous table, if we use the 10-year bond as our risk-free rate, we just take the average return less the risk-free rate to give us the risk premium. What if we have a negative risk premium? As shown in the 90-day bank bills, it means we lose money if we invest in bank bills. So better invest in the risk-free assets, and it provides a better returns for no risk.